Hi, my name is Kelly Zitlow. I've been helping people with mortgages for over 25 years. And one of the things people are always asking me is, what is the difference between a conventional loan and FHA? Today we're going to dive deep into the differences between conventional loans and FHA loans. And you'll want to stay to the end for my number one tip. It's a good one. But before we get started, please do me a favor and subscribe to this channel. I truly have a passion for educating our community about home loans, and I love helping people. Please subscribe and become a part of this community. Okay, so let's get started. First, let's talk about FHA. What the heck is it? FHA is a government-backed home loan that has been around since the 1930s. It is very user-friendly and it allows for a 3.5% down payment. So as I'm talking with new home buyers or even people that have purchased before but maybe don't have a lot of money to put down, we start to evaluate what does FHA look like for the particular scenario and what does a conventional loan look like. There are some really big differences, but mostly the way that credit score impacts each of these loans, as well as waiting periods after life events, and finally how mortgage insurance works. The way that credit scores impact each one of these loans are materially different. So on FHA is a much more user-friendly program, not so much credit score driven, allows for lower credit scores, and allows for things that have happened in life. So maybe there was a bankruptcy or a foreclosure or a short sale. FHA's lending guidelines are much more flexible with regard to waiting to buy a house, what those waiting periods are. And the way that the mortgage insurance works on FHA, it's a flat fee based on the down payment and the amortization. It is not driven by credit score. Whereas on conventional loans allow for a primary residence, a secondary residence or vacation home, or an investment property. FHA, primary residence only. But when we think about conventional loans, really it's going to come down to credit score. Credit score is a really big deal. It's going to drive not only the interest rate on a conventional loan, but also the cost of the mortgage insurance. So as a reminder, on FHA, mortgage insurance is driven by the down payment, not credit score. On conventional, mortgage insurance is driven by the credit score and the down payment. So credit score is much more important on a conventional loan when we get into the details. Now, the way that mortgage insurance works on the two loans is completely different. There's always a lot of questions that stems around how mortgage insurance works on FHA. So let's just get into that. One, know that with an FHA loan, you're going to pay mortgage insurance on two levels. You're going to pay what's called upfront mortgage insurance. It is currently 1.75% of the base loan amount, and that gets financed into the loan and amortized over that 30-year amortization. Secondly, you're going to pay annual mortgage insurance on an FHA loan, and for a loan amount that is less than 5% down, remember the minimum down payment on an FHA loan is 3.5%. So if you're putting less than 5% down and you are doing a 30-year amortized loan, then the cost of the mortgage insurance is a flat fee. It is 0.85% of the base loan amount. That's how mortgage insurance works. Now, the other big piece of it is a lot of people think that once your loan balance reaches under 80% loan to value, that you get to drop your mortgage insurance. Not on FHA. If you are doing less than 10% down on an FHA loan, that mortgage insurance stays on the loan for the life of the loan. It never drops off. It doesn't matter how much equity you gain or what your loan to value ends up being. If you've purchased the house and doing less than 10% down, the only way you are getting out of mortgage insurance is to refinance into a conventional loan at some point, or refinance back to an FHA loan with a loan to value less than 90%. So conventional, not so much. It really is different. So in a conventional loan, you have an option of how to pay mortgage insurance. First of all, you can pay it monthly. You can finance the cost of the mortgage insurance and buy it out completely, finance it into the loan, or you can just pay the cost of the mortgage insurance, not finance it into the loan, but actually bring those funds to closing and just buy it out altogether. But let's say you choose to pay it monthly. On a conventional loan, the mortgage insurance is automatically going to drop off at some point in the life of the loan. Unlike FHA, remember, if you're doing less than 10% down, that mortgage insurance is on there for the life of the loan, as long as you're in that loan. So conventional, again, mortgage insurance is going to be driven by that credit score though, as well as the down payment. So there are pros and cons between each one of these programs. And honestly, talking with a lender that is educated in both is going to be your best bet, because sometimes FHA is a better option depending on the credit score, depending on life events, etc. And sometimes all day long, it's a conventional loan that makes sense. So being able to walk through that process, get educated, makes you a better educated buyer, and that's what we all want. We want our buyers to be empowered, understand the differences, so then you're choosing the best loan that fits your particular goals. One of the other big differences between FHA and conventional loans are loan limits. So with FHA, they generally will have a lower maximum loan amount allowed. And remember, that is set by HUD, by county, and it generally changes once per year. And then on conventional loans, the loan limits are generally higher. And I mean, like almost, like $180,000 higher, depending on the county you're in. So higher loan limits. Once you exceed that conventional conforming loan limit, most of those loans are delivered to Fannie Mae or Freddie Mac, but once you exceed that loan limit, it becomes a jumbo loan, and that allows for much, much higher loan amounts. But primary difference between conventional and FHA: loan limits, credit score, how mortgage insurance works, and life events. My number one tip is, if you are married and you are purchasing a home in a community property state, if you are using a conventional loan, the lender will not need to pull your spouse's credit. However, if you are using an FHA loan and your spouse is not going to be on the home loan, and maybe your spouse isn't going to be on the deed of trust, FHA guidelines are still going to require that your spouse's credit be pulled, which means that the lender is going to want to get the information needed to pull credit and get their authorization to pull credit. So that's the number one tip. The way that each of those programs approach somebody that's married when their spouse isn't going to be on the home loan, materially different. For more information on how to buy a house without your spouse, check out my video in the description below. So that's it. Now you know the difference between a conventional loan versus FHA. Remember, it's always recommended to work with an experienced mortgage lender to help you through the mortgage process. If that's in Arizona, California, or Colorado, please give us a call. We'd love to help. Please comment below, and don't forget to like, share, and subscribe. We'll see you next time.